Good morning, everybody, and it's a great honor to be introduced by both Manuel and Lydia. So many thanks to both of you. This morning, I would like to share with you a striking observation. Climate change has been on the table for decades, and actually nothing was happening. And suddenly, around the COP21, everything has changed. Suddenly, society has realized that climate change was the biggest risk and a very special risk that we have described as a green swan, and I will explain later. And part of this mobilization, we have central banks that now are putting climate change on the agenda for 70 of them, 70, and even the Fed is thinking about it. And interestingly, investors are benefiting more and more from products in order to align their portfolios with this new environment. So my presentation will be around that, the fact that climate change is a very special risk, the fact that everything changed at the COP21, it triggered a tsunami in terms of investment flows coming from investors, and lastly, what kind of products they can use. So I'm sorry, I'm not managing my own presentation, so I would have to say from time to time, next. So we will see that climate change is a green swan. Obviously, it's a reference to the black swan, but here we will see that it's very different. It's not a tail risk. It's here and now. It's certain. I write very likely to be polite, but it's just happening. And second, more complicated, you have many non-linear forces that are interacting with each other. It's a nice way to say that it's a mess. And third, it's putting human life at risk. And so if you have the three features, very likely a lot of non-linear forces interacting with each other and putting life at risk, it's very different for all kinds of risks, but the virus that is very similar to these features. And now this problem, this risk is number one at Davos and even at the agenda of central banks. Now, interestingly, investors have heard it. They are getting more and more mobilized in terms of voting, in terms of integration, and even more in terms of influence. You know how have 500 investors representing $45 trillion. Even central bankers are not using that kind of figure. $45 trillion are now engaging and influencing the 160 most polluting companies. And I will conclude with a concrete example of a partnership between the public and the private sector with our friends of CDP and how to align portfolios with a low carbon economy. So next, very quickly, Lydia was very nice enough to mention my background. I launched an academic center 10 years ago dedicated to sovereign wealth funds with Patrick Bolton and Joe Stiglitz. I launched the first ever coalition of asset owners committed to align their portfolios with a low carbon economy. That was the project selected at the COP21. I invented the first low carbon indexes. I launched a major PPP capital market to finance some green infrastructures in emerging markets. I've testified before the US Senate earlier this year, and I've published books and papers. So when we talk when we talk about climate change, one of the questions that we are facing is, okay, but how does it position, where is this topic compared to ESG? And here we say it's all about behind the terms, behind the definitions, what are exactly the meanings, the objectives, and what could be the impacts in terms of returns. We say that when we integrate ESG, you can have at least three different layers or three different objectives. The first one is to to play some norms like social norms like Sharia, gambling, and so on. Literature is pretty big on the fact that it's costing you some returns. We could debate about tobacco as a great example. Second, you can say, no, I don't want to lose returns. I just want to send some signals. Here, by definition, you have green bonds or engagement, neutral. Or you can say, I'm chasing some additional returns or some additional, I want to size some opportunities. And here you have three different reasons why ESG matters. The first one is that companies, corporates are more and more scrutinized. So by having a kind of 360 analysis, including governance, controversies, and so on, you try to reduce the hidden risks. The second is that the environment is shifting in terms of regulation, social norms like on taxes, and having a long-term view, you can capture some of these trends. And then, very different from the rest, you have the fact that some corporates are at risk in terms of losing their license to operate. And here you have climate change. So as the former CEO of BP said in a famous article in the Financial Times a couple of years ago, talking to his peers, you are facing an existential threat. So it's what we are talking about here. It's not about adapting, it's about surviving in an environment that does not allow a corporate to damage the planet in a free way. Next. So we know very easily, I will be quick because I don't want to waste too much time on that, but we know that we, in the worst case scenario, we are doubling the emissions, and instead of doubling the emissions, we must cut it to almost zero. It means that it's an unprecedented challenge. We have never faced something like that. It means that all countries, all corporates, all sectors will be impacted. Next. And it's being recognized at the biggest risk, as mentioned at Davos, that each year they're asking their participants how they see the risks. And for a couple of years in a row now, it's being perceived as having the highest likelihood and the highest impact, so the worst position in front of everything else. Next. Next, yeah. And if we don't succeed, what are we talking about? Here you have a paper from Science published 3 years ago. It says, in the worst case scenario, what happens at the end of the century? It doesn't look good, because you have a mix of temperatures and humidity that are putting human lives at risk. It means that, and you have the graph below, the number of days where you're above a deadly threshold. The bad news is that really it will be extremely complicated just to survive in South America, Central America, part of the US, Africa, India, Indonesia, Australia, because it's a mix of temperature and humidity. So it's not only, when we say it's a risk that puts life at risk, it's a concrete example. Next. And now in terms of asset prices, that is a question that we are facing very often. Okay, how does it translate for corporates and investors? And here it becomes very complicated, because we can say that you have at least 3 blocks of pressure on corporates. The first one is about regulation. The second is about society, and the third is about nature. Regulation means that you have more and more regulations around the planet. The first one was the COP21. For the first time ever, 195 countries agreed. But you have multiple other regulations, like on the auto car industry in Europe, or new taxes like ETS booming, as we will see, or so on and so on. It impacts asset prices. And then you have society with new consumer preferences from millennials, technological shifts, migration, health. And then you have nature. You have more and more extreme weather events, sea level rising, water scarcity, and agriculture. And the problem here, and that's a fundamental problem, is that these 3 blocks are impacting asset prices, but they are influencing each other. Society influences regulation, nature impacts regulation. And the 3 of them are nonlinear. So when you have multiple strong forces and interacting with each other in a nonlinear way, you have something that you cannot put into a model. Next. And to very quickly to take some examples of these major shifts, here you have the price of ETS in Europe before the COVID-19. But the fact that the European Commission decided to fix the mechanism and suddenly the price was of the right to pollute was multiplied by 5 in about 1 year. It's very unusual to have a tax multiplied by 5 in a very short period of time. Next. To take another example, here I took an example of regulation. Here I take an example of society, and the third will be about nature. The second is about migration. Here is a paper from the World Bank that say that by 2050, so in the next 30 years, we could have at least, just in 3 regions, 143 million migrants due to climate change, including 17 in South America. Next. So we had regulation, we had society, and now an example on nature. Here you have the number of extreme weather events that have been multiplied by 4 over the past 40 years. And even worse, there's an insurance gap, meaning that when an event happens, insurance companies are not covering the costs. And the gap is pretty high because you see that it's about my eyes are becoming too bad, but it's more than 90% in Asia or in Africa. Next. And so that's why we coined this term Green Swan. And it's a book that we published with the BIS, the Banque de France and Columbia University. And it has been quite successful because it has been downloaded more than 80,000 times since the beginning of the year. And next. But to make a long story short, and maybe a graph speaks by itself, or a cartoon, here you have 4 kids, and the one says, yes, the planet got destroyed, but for a beautiful moment in time, we created a lot of value for shareholders. And it's all the topic. The idea that we can extract some value from society in the benefit of shareholders is almost over. Corporates can less and less play the roles of being predatory with society without being penalized. And that's why if you have such corporates in your portfolio, you're at risk. So that was I would say the gloomy part of the presentation. But now we can switch to the next slide that is much more optimistic. It turns out that at the COP21 around, and just yesterday compared to decades that we had on climate change before, everything has changed. And I think it's super important to capture that moment, especially when people are slightly pessimistic. Yes, we are running a race, but the good news is that we started to run about 5 years ago. And when it happens, we can be optimistic. If we remember, 5 years ago, we had deniers. They have disappeared. And the last one is leaving his office January 20. 5 years ago, it was one of many risks. Now it's the biggest risk. 5 years ago, you had limited regulations. Now they are booming everywhere, in China, everywhere. You had no global agreement. We have to remember that none of the countries had been successful at getting an agreement, and we got the COP21. It was a moment of history. China was blocking. Now China is leading. You had limited interest within populations. Now the millennials are in. It was for economists only. Now we can observe in our day-to-day lives something is happening. The cost of renewable energy was very high. Now they have competitive pricing. The few European investors were mobilized. Now we have, for example, these 500 investors representing $45 trillion. And it was a progressist agenda. Now even the Fed says they're at risk with climate change, and you have the 70 central banks. So what I'm trying to say here is that none of these forces will be enough to get an impact. But when suddenly they got all aligned, then you have a tipping point. And that's exactly the moment we are living now. Next. And so to give a concrete example, in December 17, so less than 3 years ago, at the One Planet Summit organized by President Macron in France, 8 central banks decided to work together. Less than 3 years later, this group has shifting from 8 to 65. It's huge. And it includes the Bundesbank, the ECB, the Bank of England, Singapore, and so on and so on, and so on. Mexico, and so on. And not because central banks have changed their agenda, but because they recognize that climate-related risks, that the almost last bullet point, are source of financial risk. They are all recognizing that it threatens financial stability. And so if climate change is a risk for the Bundesbank, how is that possible? It's not a risk for all German investors. Next. And how does it translate for investors? Tsunami. Here you have a graph that comes from Deutsche Bank that say that now responsible, you see the graph, it was almost nothing just a couple of years ago, and now it's booming. It's already representing $30 trillion. But even more interestingly, they expect the market to be at $45 trillion by the end of next year, a 15 trillion increase. And even more interestingly, they think that it will reach $125 trillion by 2030, at the end of the decade, 95 of the AUM percent. So it means that it's no more, it's the new normal. Next. So now how can they play, how can investors play that major shift, this almost tectonic shift? Here you have an example of a solution developed with CDP. CDP is the pioneer in terms of carbon disclosure. They've been around for decades, capturing the carbon footprint of corporates, and we are all around the planet using that data. Even the other providers are actually going to the source of the data, CDP. Next. And what we do is that with their help, we are screening the universe in order to select only the corporate that have a good strategy, that are aligned with the 1.5 degrees objective. So we try to select the winners of this war. And after that, I won't be long, but we add some other filters. But it's important to be well positioned, but you still need to have some good standard financial criteria. And so we have a screening in terms of usual figures, and we have as well a portfolio construction that tries to reduce the risks. Next. So for that means, just to conclude, we have these different filters. And to conclude, next. That means that we reduce the number of stocks that we are investing in, and then we use standard financial metrics. And I will close here. Thank you.
Many thanks, Fred, for your very, as always, illustrative presentation. We are very, very pleased to have you on board. And I wanted to, we have received some questions that I would like to share with you. I know we're a bit with the time. I will just mention two, and if you could help us being brief also with your answers, that'd be helpful. The first question is, investments in coal-based power generators are no longer eligible by the vast majority of investors due to the consequences of climate change that they bring. Do you think that oil investments will become an stranded asset in the near future? That's the first question for you, please.
If we stick with the figures, we know that we have about 2,800 gigaton of CO2 of proven reserves. And we know that we can spend only about 1,400, out of which we have already burned about 300. So basically, we have a budget for the planet that is much lower than the proven reserves of all the oil companies. So one way or the other one, countries, oil companies, and so on, yes, under a huge pressure because many of the assets will not be possibly used. That said, does it mean the end of the oil corporates? we see a very interesting trend with many corporates switching from being oil producers towards being energy producers, like Total or some others. So actually, corporates, oil companies are trying to reinvent themselves and to mobilize all their engineers, all their knowledge to switch from point A to point B. So what I'm trying to say here is to say, yes, we have a problem with the fossil reserves, but doesn't mean necessarily the end of the oil companies.
Thank you. And the second question is, do you think the effects of climate change are creating new opportunities for the business in this new economy?
Absolutely. I mean, we all have in mind the example of Next Era or and the others. It's totally a Schumpeterian process where you have destruction and wealth creation. It means that it's our job as investors to reduce the risks, to identify the corporates that are not well positioned, and on the other side to capture the ones that are very well, that have anticipating and that are executing the right strategy. We could think as well about Tesla. It speaks by itself. So it means that active management is in a world where things are changing very fast with a lot of noise or entropy. The quality of the analysis is back into the picture.